we jump over to Vol. So 25K resistance gets rejected, market comes down, and in true crypto fashion, market comes down, Vol comes down, right? So as we're back into the range, implied Vols got whacked, a load of calls got resold to the market, kind of anticipating that the break higher is not happening, so there's no need for Vol to stay elevated, and so things started to reset lower. Realized Vol then followed suit, so you can see implied move first. So you can see implied Vols went down there, realized kind of held up, and then realized collapsed later. So in this case, the implieds led the realized Vol down. Okay. If we look at Ethereum, kind of moving down in unison, a bit more together, I would say, over the course of the last 2 weeks. There, as Ethereum Vols maybe not getting whacked as quickly as Bitcoin because they weren't as elevated as Bitcoin in terms of where they normally trade. Anyway, realized Vols down 20 points on Bitcoin and 10 points on Ethereum. So that takes volatility carry, which was briefly in negative territory, which is good for the long gammers, is now back to positive territory. So you've got more positive carry in Ethereum relative to Bitcoin. So not much gap between implied and realized on Bitcoin there. As I said, dumping of calls really accelerated the implied Vol collapse that we saw, and then the usual systematic Vol selling that you get after expiry and you get into the weekends came and kind of helped that along. PCE inflation data obviously took stocks down, and crypto markets just couldn't stay up there basically. Okay, carries back to median levels though. Short dated implied Vol looks fair here to slightly cheap, but once again, even though it's cheap, doesn't mean it's actually going to work. So I think we probably need some sort of catalyst to break out of this range. So unless we break below 21K or break above 25K, we could chop around in this fairly wide 4,000 point range and not really go too far, which may be the scenario we get for the next week or so, or even longer. Okay, moving on. We look at term structure. So a typical sort of move in term structure that you would expect when realized Vol comes down. We see the contango coming back in the curve. See those curves collapsing lower with the front end taking the brunt of the hit. Now they're trading in line. So you can see here the kind of spread between ETH and Bitcoin where we track is kind of is around about 5 to 6 Vols across the curve here. That's the green line. So you know we do think that's good value. You look at a 2-year history on this spread. It very rarely gets below 0. And it doesn't tend to stay there for very long. And currently it's about 5 Vols. So we think it's on the cheap side. We do think it's got the potential to rally to maybe 10 or 20 Vols, particularly if this Shanghai upgrade starts to get more press and more airtime and it starts to create more gyrations in the price, then you'd expect ETH Vol to catch a bit of a bid. So definitely the right way round to be on that spread in our opinion. Yeah, and particularly in the long-term part of the curve where, I wouldn't necessarily care so much for the front end, like the weeklies, because anything can happen there. But if we go out to 3-6 months, even out to September expiry, like we entered those strangle swaps last week, makes sense because you don't have too much time decay to worry about. So your realized Vol in the super short term isn't having a big impact on your position. And it's all about how they price the Vega and how they price the implied Vol. And we can be fairly confident the implied Vol spread is going to head higher. And then the Vega remark of those September positions is going to make you your money, basically. So that's why we park ourselves in the longer part of the curve to not take too much realized exposure. Then if we move on to SKEW normalizing back towards flat, as upside momentum has been lost. So the SKEW obviously dipped into call territory, is heading back there in Bitcoin. You can see Ethereum SKEW on the other hand still remains for puts. That's across 1 month and 3 month expiries. So in general, you got the upside being driven by Bitcoin, call SKEW leading the way, call SKEW going bid on the weeklies especially, but also on the back end. Now you've seen that all revert back down to be about 1 Vol point out to 3 months on Bitcoin. The longer dated stuff still sits at around 2 Vols for a call premium. We still think that's a bit of a fade, to be honest. The longer dated we go, we think the macro is gonna have more impact, and we struggle to see Bitcoin really materially breaking 30K. And then Ethereum SKEW converging back as well towards neutral, but coming from the other side because it was for the puts. The puts were trading at 4 Vols over. Now they're tightening to about 3 Vols in the middle of the curve and even 2 Vols in the extremes, the 1 week or the longer dated stuff. So in general, Ethereum put SKEW coming back a bit and Bitcoin call SKEW coming back a bit. So everything getting a bit closer to home. Like we said, that call bid in Bitcoin makes structural hedging using risk reversals look very good for Bitcoin. So if you've got, players with large treasuries in Bitcoin may want to look at doing those sort of structural riskies on a systematic basis. It certainly sets up well right now. We think that flow is going to increase. So if Bitcoin gets to 28K, maybe people will have more conviction, right, it's done for now, and they might enter more of those hedges. So we think that's likely. And then the persistent put skew in Ethereum is potentially a selling opportunity for those who are underweight Ethereum and looking to add exposure to what has become a deflationary asset, right? Obviously, Ethereum, with the whole burn rate of Ethereum increasing based on transaction activity and stuff like that, turns into a deflationary asset. We haven't seen big price impact from the fact that it turned deflationary, I think, earlier in the month. But it is a fact that it has that potential. And therefore, it may well at some point become a narrative that the market latches onto again, that whole sound money narrative. Okay, looking at the individual dashboards, we could just see on the strategy compass, where are we? We're more neutral in spot than we were now, obviously back in the middle of the range, but Vols obviously screening pretty cheap, and carry is pretty minimal in the lower percentile rank. So scooping up some Bitcoin Vol doesn't look ridiculous here. Like I say, for me, I'll probably wait until I saw a real catalyst for it to move. Looking at Ethereum, implied do look cheap. Obviously, the spread looks cheap. Therefore, Ethereum Vol is going to look cheap if Bitcoin Vol looks cheap. That makes sense. But the carry doesn't look quite as great. We're looking at 8 Vols positive in the median levels, around 54 percentile. So I'm personally not in a rush to add a load of Theta Bill given the current setup here. And then jumping over to what we saw in crypto flows this week, volumes did drop off a bit, obviously, as we failed to break out, and then a load of those 24th of February call options that had been bought rolled off as well. So a lot of positions just getting cleansed out of the market. We did see some good two-way flow in March, 3rd of March, so this Friday, and 31st of March, end of the month. So upside calls trading in the 25 to 27 lines. So that's all this activity here. Some selling and some buying going on. Lots of on-screen buyers, some big blocks being sold as people just kind of giving up the ghost on the rally for a little bit and wanting to get their premium back. Put protection buying did come in. You can see a load of put protections here in the whole 24 all the way down to 19 strike. Some rolling down of puts as well there. It's via ratio spreads. And then also, if you look at what's going on the upside, June, some outright calls being bought in June on the 45K strike. So low delta stuff. And then December, the 35K, 40K outright calls also being bought. So really long dated stuff being bought quite far out of the money. And then this September, December 50, 60 call calendar, that's these two here, also was a buyer. So buying the December to sell the September. Moving on to Ethereum flows, we saw still very call dominated, some two-way on puts with buyers of the 3rd of March 1600 puts and the 30th of June 1000 puts. So you can see those here, but then there were some puts sold in May to kind of counterbalance that. So again, sort of general two-way flows if we include all the different maturities and strikes on puts. Upside was bought in many forms. Notably, the clips were the 10th of March, this yellow bar here, the 1700 outright calls, looking relatively cheap if you're bullish, thinking we could break that 1700 area. Then we had some big June 16, 21 call spreads in a decent clip. And then there was this big convexity trade where someone sold the 2500s to buy 3 times the 3500 calls in June. Okay, so that trade is quite far out of the money. I think it's like a 15 delta versus a 5 delta 1x3. It's got no headline delta on it, but someone deciding to pay up for that wing on the 3500. They paid a 10 vol premium for it. So those strikes traded at 10 vols above the 2500 strikes. But someone thinking that if we really did get going on Ethereum to the upside, then we could go to a whole new vol regime, and paying that 10 vol premium doesn't matter because you're going to kick into so much Vega that convexity is really going to work well for you, basically. Okay, so next up, let's look at gamma positioning and what that looks like. So dealers are a bit more neutral. So we had the 24th of February upside shorts all rolling off, okay, or expiring. And then the calls that got dumped back onto market makers' books that kind of people gave up on the rally, that's kind of made the positioning a bit more neutral. Okay, so you can see here that we spiked to a very negative gamma position, and now we've recovered and we're kind of back to here. We are still in negative gamma territory, but it's not big numbers particularly, right? So it's not enough to make us think there's a lot of squeeze potential like there has been in recent weeks. Okay, looking at the strikes here, you can see BTC dealers are still short this upside between the 25 and 28 area, but they're long the 24 strike as well against it. So that's going to make it more look like a bit of a ratio trade that they've got on because we're below that 24 strike. So there's not as much sting in terms of the gamma squeeze. And through time, all of these upsides are decaying. So they have less and less gamma on them. And actually the 24s are going to pick up gamma as we get closer to expiry, right? And these expiries are 31st of March. So we think that the positioning is not as fragile on the upside. So maybe that takes out some impetus for a squeeze. Looking at Ethereum positioning, dealers are long here. And, you can see here, it's primarily these purple bars where it was coming from, which is March expiry, anywhere from 1,600 to 1,900 strikes. Now, this might flip. If we were to break 1,700, it might be a case of buyers of Ethereum calls will come in this area up here and take the street short that upside, and the street will be able to provide it because they've got a load of local long volatility. So it might be that there's inventory to be able to supply buyers if we break. But whilst we don't break, these guys are just kind of bleeding on this inventory of vol, and you're probably going to see Ethereum vols continue to compress, right? As we've seen this week, right? They've come down pretty hard, just like Bitcoin vols have. Okay, so that's what positioning. So like I said, not as fragile a setup, not as much of a squeeze, I don't think. Okay, that's the summary for crypto this week, and I will catch you all on the Macro Daily tomorrow. Cheers.